What does it take to get rich? There's no easy answer, of course, because if there was, there'd be a lot more billionaires. But if you ask people who have managed to build wealth over a period of time, you'll probably get a fair idea of the thumb rules to follow, and more importantly, the pitfalls to avoid. On this episode of Big Decisions, we're talking about the rules of the mind and the rules of the heart that'll help you create wealth. My guest today is Feroze Azeez, Deputy Chief Executive Officer of Anand Rathi Wealth. Over the years, he's helped millions set out on their path to create lasting wealth. Feroze, thanks so much for taking the time.
Thank you, Alex. It's
great. So let's start with that first question, right? The rules of the mind. And that's the most critical part, because equally, there are rules that you follow and there are rules that tell you what to avoid. But according to you, in the years that you've spent telling people how they should better manage their money, what's the first rule to follow?
See, the first rule to follow is to understand where you are very correctly and where you wish to go, and equally correctly. Of course, this path of where you wish to be is not going to happen as you envisage all the time. But having a clear plan of where you wish to go is seldom there. Now, I was speaking to some large guy who has about 35 crores of his current net worth. Okay, if I ask him what's the end point, what's the destination you have, he says, I don't have a target. जितना पैसा बन जाए उतना अच्छा.
हाँ.
तो मैंने कहा यार, ऐसे थोड़ा ना आप अपना business, when you're running your business, you will have a target, you will have a guidance. We gave our results a few days back. People, if I said जितना profit बन जाए उतना अच्छा, people laugh at me, right? So when it comes to personal wealth, people not wanting to set clearly defined endpoints.
Targets,
goals, right? You should have goals. There's no goal in life which is cast in stone. Doesn't mean that you don't have one. Now, if I want to lose weight, I'm going to start with saying 5 kg ghatana hai.
Huh.
I'm not saying that 5 kgs in 2 weeks, 2 months will exactly happen on the 61st day or the 60th day. It might take me 2 months more, or it might happen 15 days sooner. But not having a goal is something so popular. Profit maximization being the objective is so superfluous. It's a moving goalpost.
Yeah, and most people would say that, Feroze. And in fact, anecdotal evidence suggests that if you were to go to somebody and just off the bat saying, what do you want to do with your money? I want to build more money. That's essentially what most people say. I want more money. But they don't tell you what they need the money for.
Correct. Yes, they don't know what's the application of the money, and they also don't have a target date and an amount to that. English hides more. So I want more money. Okay, great. You don't know what you're going to use for. Okay, chalo, no problem. But how much and what date? Then you would work backwards to understand what you will need to do and to enhance the chance of that happening.
So, especially today, because of the kind of financial products available, do you think as an advisor and as a person that speaks to people, do you think that it's that much more important to ask this question first before saying, what do I need to invest in? Because invariably, Feroze, the first question that people ask is, should I invest in A, B, or D?
Correct. It's like so elementary, this question, that you can't begin to solve a jigsaw puzzle without having seen the full picture, right? So it's very, very important and irrespective, but people want to just buy products on their individual merit, which is not a great idea. Now, Google Map, now let's assume if I have to come here to your studio, which is a very, very fancy and a great studio, and first time I'm here, congratulations on a great studio. But Google Map will also ask me for a destination before it tells me the time I will take. It may go right or wrong. But not having a destination and then embarking on a path is so popularly incorrect in the world of finance.
So, I've asked a lot of young people this as well. And, we've kind of gotten a sense that a lot of people think nowadays that YOLO is in vogue. YOLO is you'll only live once. You don't need to worry about something that's 20 years down the line. Maybe people are saying, I don't want to settle down. I don't want to have kids. I don't want to set aside money for that. These people say, hey, why do I need to have an idea of what I need the money for? I have enough. I'm earning enough. I'm getting handed enough money. What's the answer to those people?
You live only once, right?
Yeah.
So then you plan for that once life at least properly? If you're going to live 7 times, then you have room for error.
Yeah.
Right? If you're believing in reincarnation, then you can say, okay, I went wrong this time, I'll go right.
In any case, you can't carry anything with you.
No problem. But the whole point is, if you're going to live once, you're going to plan for this one life properly, right? So I think whatever you're going to spend on, it's fancy to say that I have enough money today, but the life expectancy is going up, right? I was just reading, pardon if I'm wrong, but at independence, our life expectancy of an Indian male was 38, 39 years. Today, it might be 72 years. So by the time this young man becomes old enough, the life expectancy could be 85. And if it is 85, you may be 30 today, you have 55 years to live. You're going for a holiday for 5 days, you're planning for 5 days. A 55-year life, you don't want to plan for 5 hours. Well, that's sensible, great. If it makes sense to that person, then it makes sense.
Okay, so we've established the first rule of the mind, and the most important one, therefore, is to set a goal. What do you do next? Once you've decided that, okay, you've identified these are the primary goals, how do you move forward from there?
Then you check whether the goal is reasonable or unreasonable.
Okay.
Sometimes goals, if they're so aspirational, they become dreams. There has to be a balance, right? Now, of course, if you say I have a goal that I will make sure that my money is 10 times in 10 years, that's like 26% compounded return. If Warren Buffett is so popular with 23% compounded return, if I set a goal which is 26% compounded return, is it realistic? If it's realistic and if you have a strategy, great. But I don't think you can strategize for a dream. You can only strategize for a goal. The second litmus test your goal needs to go through is a degree of fairness and a high probability achieving of an outcome. I can't say I'm going to shed half my weight and think that that's a great goal to have, right? I would be happy to lose that, but...
it may not be good for you either.
It might not be good for you, right? You may fall flat on your face and you may set yourself behind, then forward. So the second is to do a litmus test of whether your goals are fair or not. How do you do that litmus test? For an Indian investor, first you see what's the birthright of your return. If all of us, right, don't give any advice, and if I'm an investor, if there's an investor who does not have any advice, he always has the right to take his money, give it to Government of India and sleep tight, no professionals needed, no expert, no market. He gets 7%.
Fixed deposit.
Fixed deposit.
Right.
Or Government of India, which is practically a zero risk.
Yeah.
If your goal is to make twice more that, it's a sensible goal to have. Because you have professional mutual fund guys, you have distributors, you have 2 layers of professionals to hire. Now, can you aspire to have 14% compounded return? That's a sensible target, and you can have an 80-90% probability to achieve that.
Why is 14% sensible?
It is sensible because if you have 7, okay, 7 is your birthright.
Sure.
You have 2 degrees of professionals.
And it's risk-free, right?
7 is risk-free.
Right.
No professionals needed, no risk needed.
Yeah.
Now you have risk appetite, you're bringing in risk appetite, that should give you a fillip.
Sure.
You're bringing in professional expertise, which might have a cumulative learning of years as an organization or as an individual, that can give you some fillip. And then you're also adding some fillip of a time. You're saying, I am okay to be patient for 10 years if you're a youngster.
Sure.
So these 3 give you a premium. And that, I think, there's no right answer, 14 and 13 and 15. I'm just telling you a thumb rule that anybody who's aspiring to have 30% return is not a great strategy because you will not be able to.
What I was getting at is that, incidentally, I was speaking to a friend and they were saying, look, the last 2 years, I've been investing with this advisor and they've gotten me 18% compounded over the last 2-3 years. But my aunt is getting 23%. So why should I not get 23%? And I was struggling to explain that perhaps your aunt is taking on risk that may not be good for her, and she didn't listen to me ultimately. So that's what I was trying to say. Why is 14% okay and 23% not?
Phenomenal. See, I get posed this question, okay, very, very frequently. 14 doesn't sound fancy for sure.
Yeah.
Right? There will be fancier numbers which can be put on the table. But the most important thing in this case, where a lady has made 23% compounded, the most important question is, what was the Nifty at that point in time? Okay, let me give you another example. I went to Calcutta. The gentleman said, I am making good 27% compounded return. Why do I need your services? I said, great. Then we got talking. I said, sir, I never lose. I either win or learn. So here I think there's a huge opportunity for me to learn. So I would want to dig deep, because 27% aap bana rahe hain, then I'll learn and teach it to 9,011 families, which I have to be responsible for. So what's the harm in learning from you? So then he told me that his business was sold in June 2020.
Right.
Which was almost the peak of the COVID.
Yeah.
So he got a reasonable amount of money in June 2020 when Nifty was 9,300. Nifty delivered 35% from that day when he invested, and he has got 27. So if passing mark is 35, because you'll at least have to do 35 if you're at least beating Nifty.
Because you're benchmarking it. Right.
So 27 in the context of a June 2020 investment is a ridiculously bad investment. But the same 27% return made when Nifty was at 18,000 and somebody made 27%, he's God. I would love to learn from him. So people generally look at absolute numbers. If my child came back from school and said, I got 32 marks, the next obvious question I would ask him is, out of how much? Is it out of 100 or 50? Right? I would not judge 32. I don't know if it's out of 100, I would be really upset. If it's out of 50, I would be relieved that my son is not the last in the class.
We've established a couple of rules. Let's talk about the next one. And you mentioned that 14%, which is a reasonable assumption to have, or a reasonable estimate to have to work with for your returns. But that's a blended thing. That's for your entire wealth, right?
Yes, that's for your entire wealth. You might have PPF, you might have real estate, all your wealth, which you're not consuming, other than the house you live in. Everything else has a purpose of growth. The aggregate return of all those assets should be 14%.
So how do you decide the combination of all of that? Because ultimately, I think, and this is where we try and get into the nitty-gritties of it, but it's hard to explain risk, right? So each asset class, and here we're talking about the likes of equity or fixed income, you mentioned fixed deposits, gold, real estate, various other things, all of them have a degree of risk associated with them. So how do you explain that?
Correct. I think the third rule is to develop a strategy.
Sure.
Strategy has different building blocks. Risk is one of the building blocks. And what is the proportion in each asset is one building block. What mutual funds will you buy will be another building block. So now coming to the risk part, risk is also easy to understand. If you define risk correctly, what happens to my money when worst happens? If you know that, then you have understood risk 80%. If 2008 kind of a situation were to happen again,
and you drop 30%.
What will be the value of my money? If you can compute that, which you can approximately, and if you are comfortable with living with that and you will still sleep that night, then you have understood risk correctly. So that's where comes the choosing the strategy. Understanding your risk is to simulate the worst possible days and internalizing that. And if you're not comfortable with that, change your strategy and choose another strategy which you can still sleep well. Any amount of money is not worth a bad night.
So, okay, so you've established and here you're talking about an asset allocation strategy, I would think, right?
Yes.
And deciding how much or what the proportion in each asset is. What comes after that? Because, and this is the tough part, right? Because how do you arrive at your strategy? Of course, you get advice from various people, but if you don't have access to that, how do you go about it?
See, I can tell you what strategy I follow. I have 55% in equity mutual funds, 10% in debt, and 35% in structured products. This is my strategy. Something like a hybrid. 35% is a little hybrid because everybody can't access structured products because the minimum amounts are large. So something in a hybrid, 10% in debt and 55% in equity mutual fund. This strategy, if I back test for 22 years and also front test, there are simulators, will not get there, you will get about a 14% kind of a return with this combination. If you're patient with it for 5-year periods.
Right.
That's the strategy. So this is the third rule. I've just told you what's my strategy for my money.
Fair point.
Right? Each one of them will have to dwell a little deeper.
And we'll discuss this on the show as well. So, okay, so establish your strategy. What's rule number 4?
Rule number 4 is don't get distracted, implement your strategy.
Okay.
See, when you're running a business also, like ARWL is a business, we are running, right? We have a certain strategy. When somebody else in your companions or competitors, whatever you want to call them, do something else, if they do well, you might get tempted and have a FOMO. Am I missing out? You will have to put blinders and implement the decided strategy. That's a tough thing to do because investing world is very distracting and everybody has an opinion on investing, right? People might not have so much of an opinion on a lawyer's job, but on an investment job, people will have an opinion. यार तू Bitcoin क्यों नहीं खरीदता? Right? Bitcoin 70,000 पे जाएगा तो सब Bitcoin की बात करेंगे. अगर NASDAQ बहुत ऊपर चला जाएगा तो उसकी बात करेंगे. So people will distract you, don't get distracted.
Or is the uncle at the party saying that I bought land in 99 and see where it's at right now?
Absolutely.
Okay, so that's stick to your strategy, stick to your guns, and then what is rule number 5?
Rule number 5 is monitor, right? You have to decide the frequency. I have decided my frequency of a 6-month monitoring of my portfolio. I might do a high frequency. If it's a beginner, at least a 1-year full review, like a health checkup is critical because you can't be a pilot. Of course, in aircrafts, there is autopilot. Doesn't mean that the pilot can keep sleeping, right? So you have to see whether you are on course and simple monitoring mechanisms have to be decided when you embark on this.
Could you elucidate on that briefly? If you're talking about very simple, I would think that if you have an overarching idea of the allocation towards equity and debt, if there is a deviation from that, that would entail correcting it at that moment.
Absolutely, Alex. Like last year, my mutual fund model portfolio went up 43%. So automatically, even if I started on 1st April with 55, that 55 outgrew the rest of the 45. So I have to bring it back and recalibrate it to 55, right? Which means I have to sell equity funds and buy a structure product or a debt fund. It's very difficult to do because equity is done so well, you don't feel tempted to sell.
But at the same time, if you make a formula, it becomes easier to do because you're not trusting your gut. Which comes to, I say trusting your gut, but trusting your heart, right? Because your heart sometimes tells you what your mind tells you not to do, right? So therefore, what are the rules of the mind? And we said at the start, without the rules of the heart and following these rules, the rules of the mind go out of the window.
Yes, rules of the mind are very difficult to follow unless you're very conscious about your heart. Like you said, heart and mind speak different languages and several times diametrically opposite languages. The mind of the 5th rule, which is to monitor and rebalance, which you just said, is very difficult to do it as a heart. Because when I meet people, when you have to reallocate money from an asset class which has done very well, sell that and buy something which has not done very well in the recent past is very good, difficult, heart-wise. And there is a name for it called a bias called recency bias.
Right.
You're going to be swayed by, your decision is going to be swayed by what has happened in the last 6 months, 1 year, right? And that's where any stock which runs up, people go to buy it. Ideally, books will tell you, which is mind, more mind, will tell you buy low, sell high.
Yeah.
But the heart will make you do exactly the opposite. Now, let me give you some very stark data. Okay, and it's a very painful data for me. India, in the year FY21, equity mutual funds, Indian HNI sold close to 1,25,000 crores of equity mutual funds, sold it, when Nifty was averaging at 11,000. Ideally, that was the time, as per the mind, everybody should have been buying. It was a screaming buy, but India equity mutual funds, other than SIPs, lost 1,25,000 crores. So that's because the heart took over. When emotions are high, heart takes over. So that's what's called recency bias, and you have to be very careful about it.
Any others?
The second thing which is definitely going to happen is not measuring. It's called the self-serving bias. You will always give more credit to yourself. When you're evaluating a mutual fund, okay, I met this gentleman, very large portfolio. The man says all mutual fund managers are duds, quote unquote.
Okay.
I said, 152 guys, all of them are idiots. I said, great.
That's probability is not very high, right?
Right, you can't pay all 152 guys, highest paid professionals in India, one of the highest paid professions. All of them are idiots is a very sweeping remark. So I said, okay, तो फिर आप किसको पैसे देते हो? मैं अपने खुद के manage करता हूँ. 153rd fund manager, he has become his own fund manager. So I asked him, how much have you beaten Nifty? He doesn't have the measurement and he's accusing the 152 to not beat Nifty.
Right.
So then if you are the 153rd, should you at least not measure it? Yeah. So people will always give them more credit and they will not be as answerable. That's called the self-serving bias.
And
the last one is to measure all of them in the same scale of measurement. See, real estate is, I have met so many HNIs. There's a guy who has 700 crores of real estate across so many properties. You can't even put it on an Excel sheet. You'll take time. Of course, you can put it on an Excel sheet. I was exaggerating. But he doesn't know the compounded return of one of his properties. And he tells me, my portfolio's compounded return should reach me third of every month. I said, for the financial assets, you want compounded return to be reported to you 12 times a year on the third. And on your physical assets, you have not measured it for the last 27 years. Measure it in compounded return. Nobody has measured real estate returns and compounded. So when I calculate a property bought in 1990 in Lodha, in Lokhandwala area, a 64 lakh rupee apartment has become 3.5 crores. The guy was so thrilled. I computed his compounded return, 7.3% return. Worse off than Government of India bought. So always use the same unit of measurement.
Or yardstick, correct.
Yardstick. If I am measuring my weight in kgs and I'm comparing with Alex's weight, it has to be better in kg, not in pound. Right? Both have to be the same scales of measurement. It's so ridiculous that the entire country never uses different scales of measurements for different asset classes and concludes where should the money, which is hard earned of 10, 20 years, be invested without even having the unit of measurement equal.
So 3 rules of the heart and 5 rules approximately of the mind. But Feroze, it's been an absolute pleasure having you on Big Decisions. Thank you so much. All right, so there you have it. We've discussed some rules that you should follow, but you know, nothing is guaranteed. There's a lot of it that is going to take work and it's going to take time and it's going to take iteration. But let us know what you think about these rules that we've discussed, and we've got lots more lined up in the coming weeks. Do stay tuned. This is NDTV Profit.